Hello and welcome to another podcast, The Change Officer, where we bring the thought leaders of the region and talk about the hottest stuff that is going on in startup community, VC industry, media and communication. And today we are not in the region. Today we are going global. And as we drink our morning coffee, I think our guest is drinking his evening tea, I would say. Hello, Bret. Is it? What's that? That's a coffee?
No, it's actually red wine.
Oh, that's good before the sleep,
Exactly.
They say, what doctors say for the red wine? They say 1 deciliter of red wine a day, it's not only good, but it's not enough.
I like that.
Yeah. So thank you very much for being here with us. And I really have to explain people why we cross the ocean and oceans or whatever, depending on which side you're going to. Anyhow, I have recently read your article about how VC industry is changing, and I was really impressed, and I'm really grateful that you accepted this invitation to our podcast, because I think you're in the hot spot where things are happening. Recently, I read an article, about unicorns in 2020, and altogether of 165 unicorns in the world, 101 were in US, mostly Silicon Valley and New York. And that's a boiling point of the world about when it comes to the VCs. So, Bret, let's start from that article. The article where you say that the seeding industry became a new industry for itself and how it is changing.
Yeah. Well, first of all, thanks very much for inviting me. I appreciate it. So I've been in Silicon Valley my entire life. So I've kind of had this opportunity to have a front row seat to watching Silicon Valley become this global center of innovation, global center of entrepreneurship, and of course, global center of venture capital. And it's changed a lot in the 40 years that I've been here in my career. And one of the ways it's changed, as you just said, is that seed financing, which used to be a check from your rich uncle that got you a year to move your startup idea from idea to something that has enough traction that you can go pitch a venture capitalist, right? That's what seed financing used to be. Because traditional venture capital is about finding entrepreneurs who have not only have an idea, but they've kind of proven out the idea. They've got some initial customer traction. They've proven that they're solving a problem that customers want to have solved, right? And as a friend of mine who's been a venture capitalist for a long time, as he says, I'm looking for a just add money opportunity. In other words, an opportunity where the entrepreneur has already taken the risk out, and now it's just add some money and it takes off, right? And so, historically, you needed some seed financing, which I said, kind of a check from your rich uncle to get you from the idea stage to being able to raise some venture capital. But what's happened in the last, let's call it 10 years. What's happened in the last 10 years is that seed financing, that stage before your first venture capital round of financing, has really become an industry of its own. That it's now not just your rich uncle, it's a whole bunch of high net worth individuals throughout Silicon Valley and beyond who have found that investing in early stage startups at that seed stage can be very lucrative. And fundamentally, what makes seed different than traditional venture capital is that the seed stage is more the gut level investment decision. I met this entrepreneur. This entrepreneur seems passionate and driven, so I'm just going to take a risk and write him a check and see what happens. Whereas venture capital needs to be a little more data driven, right? And so, as I said, that the seed stage has become an industry of its own. And if I remember correctly, the most recent data from Crunchbase and PitchBook is that last year there was over $13 billion, billion with a B, in seed financing done. And most astonishing for me is that the 2021 numbers are that I believe the average size of seed financing is now over $9 million, which is incredible because, to me, seed financing was maybe, $25,000, $50,000. And so the idea that the average seed financing is now well over $1 million is a complete change from the way it was 5 or 10 years ago.
And I think maybe one of the reasons why this stage was avoided by investors, and you said you probably rich uncle phase, or as they call it, triple F, family, friends, and fools stage. It was avoided because of that. But I think from the perspective of startup. From the perspective of startup, this is more, I would say, empathetic. Okay, I will definitely need money in a Series Z when I reach 10 million or 50 million or whatever. But at this vulnerable stage, you need someone to support you without due diligence or all the audits and everything. To support you for.
Because there's no due diligence to do. It's a slide deck and a passionate entrepreneur. That's all it is.
Yes. And how important, I think you just said it, passionate entrepreneur, but some people take this as a passionate entrepreneur equals slave. I need someone to work for me. And I heard something which I really don't like. I won't say the name of the accelerator, where the investor puts 6 people where he invested on his right side 3, on his left side 3, and he's over them 8 hours a day and pushing them to work. That's a modern way slavery, I would say.
Yeah, and I don't think that's very successful. I mean, I don't know who you're talking about, so I don't know for sure whether that approach has been successful for this person at this accelerator, but my impression is that that's not the successful approach.
Yeah, but in that article you mentioned that there are new ways without getting an equity, and when we talk about equity, founders usually forget when they're in the lack of money, they forget every minute of a stress, of tears, of this they say famous position for the entrepreneurs, like fetal position, when they take the blanket over their head and what am I doing, and that's really something that they should cherish and respect. But at the times when they need money, they forget about that. So talking about equity in that early stage can be tricky, both for an entrepreneur and for an investor. So you suggested that there is a new stream, a new way of investment on a way.
Yeah. So again, we got to sort of step back and take a look at the history. That traditional venture capital has always been structured in a very simple way, which is I'm going to give you money in return for equity in your company. And the reason that I want equity in your company is that I am betting that you are going to either have an IPO, which is basically selling the stock to the public, right? Or you're going to get acquired by Google or Oracle or Microsoft for $5 billion. And so this equity that I own will be worth 100 times what I paid for it when you have your IPO or get a big acquisition offer. So if everyone either pays off 100 to 1 or goes bankrupt, then that means you only need 1 out of every 10 to succeed, and you're making 10 times your money, right? It's basic math, yeah. And that's great if you're an Airbnb or an Uber or a Facebook or any one of these famous venture funded companies that did become billion-dollar success stories. But there's an awful lot of companies out there, an awful lot of perfectly good startups that are going to be perfectly good, 10, 50, $100 million kind of companies. But venture capital is not really a fit for them. Traditional venture capital is not a fit for them because they're not going to have a $1 billion IPO, nor they're going to go bankrupt, hopefully. They're going to be a nice, solid $50 million a year kind of company, right? And so there's been this realization in the last year or two that we structured seed financing around just simply mirroring venture capital financing, because the expectation was that the seed finance ecosystem feeds into the venture capital ecosystem. And so we should kind of use the same model. That was the original kind of reason why seed financing was structured more or less like venture capital financing. But as I said, in the last year or two, there's been this realization that there's an awful lot of companies that are perfectly good companies, but they're not going to get $100 billion offers from Google. And so, what are the ways in which we could develop financing structures that align the interests of the entrepreneur and the interests of the investor, right? Because that's all that really matters, is that we develop a financing structure that aligns the interests of the investor who wants to put out his money and have that money come back over time at some reasonable return. Align that with the interests of the entrepreneur, which is I need some capital to get my business going, and that I'm happy to pay back the investor that capital plus some reasonable rate of return. And so we've seen the growth in the last year or two of things like instead of owning equity in your company, maybe I just simply get 2% of the revenue of the company until 3 times my original investment has been returned to me. So I put $10 million into your company, you launch your company, you run your company, you pay me 2% of the revenue of your company. And after I get $30 million back after some number of years, then I'm out. As an investor, I'm happy. I tripled my money. As an entrepreneur, I'm happy because I got the startup capital. I was able to just simply put that 2% of revenue into my spreadsheets, and it's all good.
I cannot just believe one thing, that for 13 and more years, Mr. Wonderful was right. If our viewers follow Shark Tank and Kevin O'Leary as Mr. Wonderful, aka Mr. Wonderful, he is always the one shark that is suggesting that arrangement to the owner, giving some money and get it, because he's kind of happy with his 2-3 times, because you never get that level of commission from banks or for any other investment and so on. And how is it when you talk about this new model with your colleague investors and so on? How is their reaction? Because when somebody has 100 million to invest, or let's say 10 million to invest in some venture capital fund, he will expect 100 times, I'm sure. But when they hear 2-3 times, are they disappointed, or do they dig it now? Because there are thousands of companies that they could, harvest on that.
Yeah. Well, so risk and reward are always correlated, right? And so traditional venture capital has been high risk. Like I said, only 1 out of every 10 venture capital investments pays off. And so if only 1 out of every 10 pays off, then you have to have a much better than 10-to-1 return on the one that does pay off, right?
Of course.
Just basic math, right? Whereas if we lower the risk a little bit, then the lower return is fine. So, maybe if I have $100 million to put to work, maybe instead of putting that $100 million to work in the traditional equity model, instead I put that $100 million to work using this revenue share model. And then maybe out of my 10 investments that I make, maybe 3 or 4 of them succeed, right? Instead of 1. And so then all of a sudden getting 3-to-1, is fine. So I think it's just that simple equation, that risk and reward always have to be correlated. Traditional VC has always been high risk, high reward.
Yeah.
But there are other structures that are lower risk, lower reward, which are again fine because they align interests just fine.
And we, I think, rounded up a story around fourthly and fourth industrial revolution. So it was interesting where the name comes from, and then can you tell us a little bit more about how your incubator accelerator works?
Yeah, sure. So as you just alluded to, the World Economic Forum has said that we're now entering the fourth industrial revolution. And the idea is that the first industrial revolution was around the steam engine and the cotton gin, right? The second industrial revolution was around mass production and electricity. The third industrial revolution was IT, computers, the internet, the one that we've been in for the last 30 years or so. And now we're entering this new era. And the new era is kind of the intersection of the digital, the biological, and the cognitive. So we've got all these digital technologies, right? And then the biological is all of these amazing medical technologies, gene editing, all this stuff, amazing stuff on the medical side and the biological side. And the cognitive is AI, machine learning, all that stuff, right? And so this new era is the merging of those three things: the digital, the biological, and the cognitive.
I just wanted to say, as you said, the fourth era, we are coming into business. I just like to quote one of gurus of business thinking, Isaac Adiges, and he says that from the prehistoric period to steam machine, who was the stronger, he led the way. After the steam machine exchanged the power, who had the brain, he's the one who led the way. And now we have computers to exchange the brain. So what's next? And he says the next is the heart. And I really see the changes what happened, let's say recently in Microsoft, not that recently, it's even I think 4 or 5 years, when Satya Nadella came to power as a CEO after Steve Ballmer. I think that all about Satya is in empathy. And I really see correlation there with the fourthly, where it's being empathetic towards people who startups and founders and entrepreneurs, like to really push them, not expecting like a binary outcome.
Yeah. That's good. I like that a lot. And you're right. He and Ballmer are pretty much opposite personalities. So you're right.
So how does it work?
So I want to tell a really quick side story about your point about empathy. Mm-hmm. So I did a little research. So I teach at Stanford University, in addition to the other things that I do. And I did a little research project a couple of years ago about high achievers, what makes for high achievers. And I interviewed a bunch of different people about, what do you think high achievers have? What are the common threads that run between high achievers? And one night I was having a glass of wine with my friend Fred Reed, who is a high achiever. He was president of Lufthansa Airlines, and then he was the founding CEO of Virgin America Airlines, and then he ran Larry Page's new flying car company. So Fred's a super high achiever. And I said to him, so Fred, what do you think high achievers have? And he said, empathy, smarts, and tenacity. And I said, okay, Fred, that's really interesting. Smarts and tenacity, I could have predicted that, right? That makes sense. Yeah. But you led with empathy. Why did you lead with empathy? And his answer, I'll never forget this. His answer was, to be successful in business, you have to be able to efficiently negotiate with all the humans around you, right? All day long, you're negotiating with the humans above you in the organization, the humans below you in the organization, your peers, partners, vendors, et cetera, right? That's life as a CEO. You're negotiating with everybody around you. And he said, if you take any university course on successful negotiation, they will always say that the very first step to any successful negotiation is to understand what the other person cares about, right? Put yourself in the other person's shoes, which basically means empathy, right? So it basically means that if you want to have a successful negotiation with anybody on any topic, you have to first be able to empathize with what the other person cares about. And so that's why he said that he thinks that high achievers have the empathy gene. I found that fascinating.
Absolutely, I'm blown away. I was chilled when you started talking, when you said, for smarts and tenacity, yes, but for empathy. And to be very honest, I had an honor also interviewing Chris Voss, the FBA negotiator, and Never Split the Difference, bestseller book writer. He first thing he said, you have to deeply empathize and understand where the person across you is coming from. As you said, fill in the shoes. That's really so. How do you do that in Fourthly? How do you empathize with startups?
Yeah, so I'm sure of that, but let's circle back now on the fourth industrial revolution, and this is the reason why I named my new startup accelerator. I named it Fourthly, just because the World Economic Forum says we're entering this new fourth industrial revolution. And here's the thing that I think is one of the most salient aspects of the new era that we are now in, is that innovation and entrepreneurship is happening all over the world today. That, during the first industrial revolution, it was primarily around London. The second industrial revolution, it was primarily around the centers of mass production. So that's Detroit, Milano, maybe, right? So, and the third industrial revolution very much around Silicon Valley, right? And that what makes this new era that we're now entering different from any other era in human history is that it's happening all over the world. That there are clusters of innovation and entrepreneurship and risk capital all over the world today. Right? It's not just Silicon Valley and New York. It's also London. It's Dubai. It's Berlin. It's Tel Aviv. It's Florianopolis, Brazil. Right? It's these clusters of innovation and entrepreneurship that are happening all over the world today. And also, perhaps most importantly, kind of within the context of this discussion, there's been a decoupling of capital and entrepreneurship. Right? That it used to be that centers of capital and centers of innovation were always coupled, all the way back to Florence and the Renaissance, right? But today they've been decoupled because I'm fond of saying that we're now entering a place agnostic era. In other words, it no longer matters what place you're in, right? So an investor in Silicon Valley might choose to invest in a startup in Dubai or in London or in Berlin, right? And vice versa, because
because he can.
Because he can, exactly, because he can.
That's really, and one of the things that I was impressed with Fourthly, it's so based on remote. It's based on remote work. That's one of the things that I really see. When all this started, being in audio and video production industry, and I saw, who solves first in any industry, who solves first this remote thing for its industry. He will be, like on a cutting edge of it. So I think this is the first time I see incubator, accelerator, who is fully remote, meaning can give services all around the world, as you said in the fourth industrial revolution. Okay, so just one thing which is also really amazing about Fourthly is actually what we said maybe half an hour ago or so, but we said, talking about equity, you are not insisting on taking the equity, understanding where the startups are coming from and so on, and I think this is really, really amazing. Can you tell us how does it work? How the people are reacting to that? Like both those startups and investors.
Right. Yeah. So I've having been an entrepreneur myself several times. I know how valuable your hard-earned equity is. And you'll end up giving away some equity with every financing round, typically, right?
Yeah.
And then you have to, then you create an option pool to give equity to your employees, and and yada yada yada. And so you as the founder of the company, suddenly you realize at some point that you only own 10% of the company, and that's fine. That's how it works.
Yeah.
But with the current valuations that companies are getting during their financings or their seed financings, 5 or 10% of the company is a lot of money. And so for example, Y Combinator, which is kind of the most famous startup accelerator program, their deal historically has always been $125,000 for 7% of the company. And 10 years ago, when YC launched, that was a pretty fair deal. They give you 125 grand, they get 7% of the company. That's fair. But what's happened in the last few years is the valuations have gone crazy. And as I said earlier in our discussion, the average seed financing is now at about a $9 million valuation. So 7% of $9 million, is $630,000, right? And so if you're giving away 7% of your company for an accelerator program, that's a lot of money. And so I just decided that when I created Fourthly, I just decided, hey, you know what? We'll just do this as a very simple fee for service accelerator. In other words, you pay me to participate, and you keep all of your equity. And partly that's differentiation. Partly that just differentiates my accelerator from all the other accelerators. But partly that's because, as I said, I've been an entrepreneur. I know how much you work for every single percentage point of equity. And I'd rather have you keep that equity and use it for future purposes and not give it away to me just for participating in my accelerator program. So that's what I did.
That's amazing. We will definitely put all the links to Fourthly to our YouTube or any other post of this podcast. Bret, I really wish to thank you a lot for this conversation, but I have one last question, because you are in the hotspot of the venture capitalism and what's going on right now, what happened just a week ago with Facebook astonished me. And do you have some your perspective on that? What actually happened? Because not too many people are that involved in the industry like you.
Yeah. Yeah, that was definitely a fascinating story. I believe it was the largest one-day drop.
Yes.
In stock price in the history of the American stock market.
Yes, it was. Yeah, it was 26% for a day.
Right. So I don't have any inside knowledge, although I was actually at the Christmas party in I believe that would have been 2007, where Mark Zuckerberg met Sheryl Sandberg and hired Sheryl to run the business side. But other than that, I don't have any inside knowledge. But I will tell you this. So first of all, Facebook's user growth has been so incredible for so many years that it wasn't going to last forever, right? There's no way that lasts forever.
They extinguished all the people, everybody's there. Yeah.
So the fact that they reported their first ever drop in user volume, it's not too surprising. And honestly, it's one of the reasons why they bought Instagram and they bought WhatsApp, was that they knew that Facebook was not going to grow forever, and so by buying Instagram and WhatsApp, they kind of distributed their risk a little bit and entered into some new demographics. So the drop in users, not too surprising. The most surprising number that came out during their earnings call on Wednesday or Thursday last week, was that Apple's change to the way in which iOS now requires users to opt into being tracked, right? Mm-hmm. So now when you load up the Facebook app on your iPhone, iOS gives you a message saying, would you like to give this app permission to track your activity or not? And most users, if they're presented with that message, most users will say no, right?
Yeah. And that's a basic source of income for Facebook.
And so, so the surprising number on that earnings call last week was that the CFO of Facebook said that he thinks that change to Apple's opt-in policy on iOS was going to cost Facebook $10 billion in revenue in 2022. So
out of 30, yeah.
That's a very large number, right? So I think probably that more than anything else is why the stock price dropped, is that, when they all of a sudden said that their 2022 revenue was going to be $10 billion less than everybody thought because of this one change, that spooked everybody. But here's the broader picture of what's going on right now. So you've probably heard the term Web3, which is this hot buzzword right now, right? And nobody knows exactly what Web3 is, but there's a lot of opinions about what it might be. But the general notion is that we definitely seem to be coming to the end of one particular web era, and we're entering, some next era in the web. And in Web 2, the area that we seem to be kind of now exiting, has been very much dominated by Google and Facebook, right? Those have been the two big players. They're the two largest advertising platforms in the internet. I think the two of them together control almost 2/3 of.
Yes, 70%, yeah.
Oh, so over 2/3 then, right? So, it's basically a duopoly where two companies control the vast majority of the digital ad dollars. And that's been Web 2, was really about Google and Facebook. And we're now, kind of entering a new era. And there's definitely kind of the pendulum, everybody thinks the pendulum is going to swing the other way, that instead of this centralization that was part of Web 2, where, kind of everything in the world, all the content in the world, all the eyeballs in the world, all the advertising dollars in the world have gone through Google and Facebook in Web 2, that Web 3 will see more disaggregation and more decentralization. And I don't know exactly how that will play out, but I think that's the big trend, and that's the biggest single reason for their stock price drop last week.
Definitely, even us in a let's say linear Web 2 world are thinking about how to go to Web 3, how to go to decentralization and go to NFTs, another buzzword, and so on. Bret, thank you very, very much for your time. I know it's late, but finish your glass of wine. Doctors say it's healthy. And I really sincerely hope to keep in touch and in no time to make some podcast about some success story from Fourthly, hopefully.
Excellent. Thank you so much.
Thank you so much, Bret. Thank you so much for watching the Change Officer podcast. I think Bret is an amazing officer, the change officer, being there in industry for years. One of the things interesting for Bret, he raised $7.5 million in 1991. Most of our viewers are not that old even, but that means that he witnessed all the changes that are happening in the Silicon Valley, and he mentioned also about decentralization, about the stuff that is going on and going towards the decentralized, not only internet, but also decentralized powers of the industry revolution. Thank you very much for watching The Change Officer. Don't forget to subscribe and like, and hope to see you soon in the next exciting episode of The Change Officer.